And now, The Money Show
with Stephen Grootes on 702.
Let's walk the talk.
The Money Show with Stephen Grootes is brought to you by ABSA CIB, honoured by the 2025 Salter Awards. Good evening, welcome to the programme. I'm Stephen Grootes, and I suppose a day that will be remembered sort of for the kind of great recovery. Well, I suppose you could say a kind of mid-sized bounce after what we saw, the drama we saw in stock markets yesterday, although to be fair, quite a significant recovery in most places. Did depend sort of on where you are. The JSE doing very nicely. We'll understand why. A bit of bargain hunting, perhaps. It was sort of companies with good, strong names, if you like, that seemed to do the best today. And perhaps investors just thinking this is now the right time. It's a right price. But the story around the US-China trade war perhaps is going to start to dominate all of this. Tomorrow, American time, in other words, sort of very late tomorrow, early Thursday, our time, we expect US tariffs of 104% to be imposed on Chinese goods. China's saying today that they will fight the tariff war until the end. You can look at all sorts of ways of looking at that, talking about US blackmail as well. And then the US President Donald Trump saying on social media today that there will be a deal with Beijing. I mean, he dressed it up in lots of aggressive language, but there will be a deal. It doesn't look like China's in the mood for a deal, and maybe they want to sort of test their strength. On the other hand, they do have economic problems to worry about as well themselves. We'll look at that in the next little while. Fascinating comment, and I've seen a little bit of analysis heading this way, but I haven't really seen someone quite so prominent as saying it. The CEO of Euronext is the company that provides kind of stock exchange services across Europe. Stefan Bujna is his name. He said, and I wonder how you will interpret how he says this. So it's entirely up to you. You tell me. The US is behaving like an emerging market, not a developed country. In case you're wondering, we're an emerging market. I don't know if I really like the comparison, Mr. Bujna, sir. I mean, I'm not entirely sure that I find that, very positive. Thanks very much indeed. You might have an interesting view. The US is behaving like an emerging market, not a developed country. 011-883-0702 and 0214460567. Also, of course, in a moment, more on the coalition. It does look like the DA leader, John Steenhuisen, kind of indicating they want to say Fikile Mbalula pressing the reset button. He's the Secretary General of the ANC. Do stick around for a conversation we'll have with Ian Williamson in about half an hour from now. He's the sort of outgoing, departing group CEO at Old Mutual. He's been there for a very long time, managed the company through some of the toughest of times too. And I think if you're anyone who has any ambition whatsoever with what you want to do, maybe a good moment to just sit back. You may be a good person to take some advice from and just some pointers about how to manage all sorts of things. He has a family, work-life balance will be one of the issues, but also managing a big company during a difficult time. And I'm thinking COVID, internal disputes. Remember when he took over? None of it his doing, but just the situation he was in. So might just be a good person to listen to. And personal finance tonight, what to do if you're retiring now and looking at the stock exchanges that you saw yesterday. We look for some glimmer of hopes, what to do. I mean, I'm always reminded of the story of, you hear via somebody's previous dog owner that in fact, somebody during the at the start of the pandemic, remember that day when shares just dived ahead of the hard lockdown? And some people took all their money out. They lost a huge amount of money because markets did come back quite strongly after that. But how do you retire in that situation? Looking forward to that conversation. You may be someone or know someone in that position. We'll do that after 7:30. Good to have you along with us on The Money Show tonight.
702. Stephen is on The Money Show.
6 to 8 p.m.
Well, a strong statement really from the ANC Secretary General, Fikile Mbalula, speaking on behalf of the party's National Working Committee, that the ANC is going to reset the national coalition. They'll be speaking to parties in the coalition, but also, it seems, outside the coalition. And of course, this is after the DA voted against the ANC-supported budget last week and the huge dispute between them. Dr. Kagiso Poe is a public policy specialist at the Wits School of Governance. TK, good evening. Good to have you along with us tonight. I mean, how do you understand the word reset? Does it mean the creation of something completely different? Or is the ANC just trying to sort of reset the power balance in the existing coalition?
Evening, Stephen. Thanks for having me. Well, I think the only measurement for reset is I'm thinking of when former President George Bush said he was resetting the relationship Russia, and there was a symbolic button which was placed there. And I think it maybe speaks to saying, listen, and again, it's never a healthy thing to try and analyze the mind of the Secretary General of the ANC, or trying to say, listen, maybe cooler tempers and let's maybe go back to a framework. But again, I think the problem I've always had with the Grand Coalition is we still don't know what this framework is about. So maybe that's part of it, to say, listen, let's really get our I's and T's crossed so that we know exactly what we're both standing on, what we disagree on, and maybe find a healthier way to do it. But that's the positive side of it. Because if he's maybe going for, if we have to be a bit more negative, say, listen, we're looking to really maybe get rid of the DA, it'd be interesting to see what numbers and which parties he'd be approaching to get to such a number.
Well, I mean, this is the complication. I mean, there's a fascinating article by Gayton McKenzie, the leader of the Patriotic Alliance. He's also the Minister of Sport, Arts and Culture, in Business Live this evening. They're talking about why the coalition must stay as it is. And he's very frank about his own disagreements with the DA. But he says to govern without them becomes almost impossible simply because of the numbers for the ANC.
Well, it's not actually that impossible, because if they go to, I think the normal strategy is confidence and supply, which is to say we will vote on an ad hoc basis, because that's the way if it goes down to voting. But maybe what he's speaking about is the symbolism more than anything else, that you need to kind of have the DA there for purposes of saying, listen, we're getting a unified front in terms of handling governance issues. But I'll probably disagree with him to say, look, if I'm a citizen, whether you guys get along or not is neither of my concern. My key worry seems to be that we're literally going past a year, and the key question is South Africa better? And maybe that speaks to the issue I've always had with the Grand Coalition, which is it's more optics than the realities of governance and fixing South Africa. And I think that's what we should be pressing them on, to say, we hear you, Mr. McKenzie. It's good that you and your personal issues can be set aside. But how is the normal South African and how is the economy really going to profit from you guys still being in this thing together? Because it means nothing if we have, people holding hands for Kumbaya for 5 years, but then South Africa simply just is dying as an economy.
I mean, there's also the question of whether other parties could come in. And I suspect that MK might just be a stretch too far. But Julius Malema's EFF, I mean, losing influence, perhaps desperate for a new stage, perhaps feeling a little out of things. I mean, is this an opportunity for that or not?
It would be, but it would be interesting what the dynamics within the ANC would be for that. Because let us not forget, there's a reason why Mr. Malema was a former Youth League president and then was the ex-former Youth League president. Not everybody in the ANC is a fan of Mr. Malema. So I don't think it's an easy transition to simply say, listen, he enters in, because as many in the ANC would say, listen, in him entering in, remembering they've got their own election coming through, it almost, for certain people, might throw a spanner in the works for their ambitions. So I think it's almost like a red herring, and it just happens to be red. There's nothing we can do about it. It's a red herring that happens to be, then you're right in saying that for relevancy, for them, this would be quite the coup. But it would be interesting who in the ANC would actually advocate for him to go back there. I'd make the argument it's probably easier to make an argument for MK over the EFF.
And I mean, I'm reminded, I think the EFF tonight issuing a statement saying they're going to court essentially to stop the adoption of the fiscal framework in the same way the DA is. So, I mean, it's one thing to say you want to throw the DA out because they're against the budget, but so is the EFF. They're doing exactly what the DA has done. And I wondered almost if that was deliberate on the part of the EFF.
No, it is. Look, like you said, you kind of kept it correctly. They need to look like they've got wins at the moment. For the DA, I think part of what they're doing is really to speak to their core voter base, where I don't think they really got the best out of this negotiation with the Grand Coalition heading into it. So it's almost like saying, listen, now we start to renegotiate and recalibrate things. But for the EFF, it's the same. They need to look like they're still alive within the body politic of South Africa, because you have to remember, they're not even the official opposition. That's the position that is occupied, not greatly at the moment, but by MK.
Fikile Mbalula making what I thought was an important comment about rules. He says that a coalition needs rules. And this reminded me of how many people had said before the elections last year that coalitions that have public and binding coalition agreements signed by all the parties before they start governing together are much more likely to survive, to be durable. And through all of this has been the one big handicap. There are no rules. Is the window opening maybe for that kind of agreement? And that surely would actually improve governance and would make things better for everybody, including the parties involved.
Yes, and now remember having discussions before the election that was a key thing that I think our political elites are very poor at this. That look, they should have been able to calculate what if this is a situation. I know there was discussion, especially for local government, but I think we're in a situation where we do need rules overall. But then the key thing sometimes I think South Africa becomes a nation that's over-legislated. In other countries, yes, there are rules, but the rules don't become binding laws. And it's an issue of saying you almost have to say, listen, the political elites has a maturity about them, which is these rules, while not laws, are things we can all agree to and respect. So I always find it interesting, are they speaking about hardcore rules or are they speaking about laws? Because if you simply go on laws, that doesn't really, it doesn't create trust. It doesn't create a good working relationship. Yes, it's a framework. But I think what South Africans are looking for is to be able to say, listen, if you have your disagreements, surely it's about compromise at the end of the day. And if you cannot even do that, how do you now legislate that in terms of laws? What does that look like? And I think that's the complication. And remember, this is just maybe one of the processes, because whatever is going to come out from these rules, they're going to go towards the legal framework, because that's how South Africa seems to work. And I just wonder what that is going to look like. I'd rather them be proactive at the moment and actually show, look, a genuineness about how they should want to work towards. And I think, maybe I'm speaking from a position of being privileged here, but my understanding is South Africa's problems are quite clear. If you cannot coalesce around the economy, public infrastructure, and making sure that we get a better economy going forward globally, then I'm not quite sure what we're doing.
Yeah, all about jobs as well, of course, which is connected to all of the things you talk about. Dr. Kagiso Poe, really appreciate the time. Thank you. Public Policy Specialist at the Wits School of Governance.
The Money Show on 702.
Monday to Friday, 6 to 8 p.m.
How many times have you heard promises from politicians and officials that there will be changes and improvements in the provision of water? So, while dams are full, as they are kind of right now, in fact, the Vaal Dam is overfull, some councils still can't get water to your home. This is happening in many parts of the country. And it seems the major problem is not the water boards, it's not the bulk supply, it's the councils. And the problem with that is that each council that fails is its own little personal and political tragedy of how it ended up in that position. Now it does seem that there is some serious movement. JP Landman is a political and trend analyst who's been looking at this very closely. JP, good evening. Good to talk to you again. It's been a long time. There's a long list of government interventions that are underway. Many of them are dealing with local government, and one of them is about licensing reform. What impact are you expecting that to have?
Hello, Stephen. Yes, good evening. Good to talk to you again. Indeed, the amendments which are now before Parliament, amendments to the Water Act, is that water service providers, the people that actually bring the water into your house, into the tap, must be licensed after they meet certain competency and ongoing performance requirements. If a water service provider loses the license, the license is given to somebody else, and that somebody else can be a for-profit private sector organization, it can be a not-for-profit private sector organization, it can be a community organization, an NGO, and so on and so forth. And what this will do is to hold municipalities, which are effectively at the moment the water service providers across the country, with one or two exceptions. The water in your tap comes from a municipality. They are the water service providers, but at the moment there are no competency and performance conditions which are imposed on them. Bringing in the licensing system will enable that to be done. And if a municipality then, or the water service provider, doesn't perform to standard, you take the license away, you give it to somebody else. This was done in Brazil, and it has had remarkable successful consequences. In South Africa, there are only two water service providers, the one in Mbombela, in Mpumalanga, the other one on the Dolphin Coast in KZN, where the water is provided not by the municipality, but by a private water service provider. They do it under the authority and the jurisdiction of the municipality. In other words, the municipality sets the rates, and the municipality must ensure that the water service provider do the necessary. The money that is allocated by Treasury in the equitable share for poor people to give them free water, that is given to the water service provider, and they have to provide the water, and they are paid from the equitable share. It's a system that works well.
I mean, it certainly sounds like it. I mean, there are other things. So the National Treasury is holding out several carrots to metros, and that's fine. But as you point out, Joburg, for example, the city of Joburg has not done what it's supposed to do despite, dozens of meetings with provincial officials. I mean, I look at the situation in Joburg, frankly, in despair. Do you really think it'll change, even with the carrots and even with a bit of stick?
Well, you can only try, can't you? It's no good to leaving it just as it is. In the end, the municipality of Joburg, the metro of Joburg, must cooperate and they must be willing to change. And if they don't want to change, hopefully the voters in the elections, which are now 20 months away, will punish them. But the idea is that Johannesburg Metro will appoint a water service provider, hopefully not itself, hopefully some other organization, and that will take over the delivery of water. And that's the only way that I think you can try and get improvement.
I mean, the private sector is getting more involved in all of this. And JP, I must confess, I'm not sure I fully understand what the private sector is going to do here. And I'd have to say that if I were someone with someone else's money to invest and I was invited to do a project with the Joburg City Council, I wouldn't run in that direction. I just wouldn't do that. So, I mean, this is the thing. I mean, I accept there's a much bigger ideological conversation around privatization, but technically, has the private sector really got the appetite to get that involved?
Well, that we will have to see. There are certainly cases where private operators are really willing to get involved, and of course, the price for them getting involved is that they have a say in how things are run. The same kind of thing that you have with the concessioning of ports and railway lines and so on. Nobody's going to put down his money and then not take a management stance or the management stake in the operation. And I think that applies to whoever is interested. Particularly in the rural areas, you will find that there are private operators that are willing to come in and take over the water provision in a town. And in the one or two cases where it has happened, it has worked very, very well to the benefit of everybody. So yes, the private sector is based on a profit motive. As long as there's money to be made, then they will come in. And I think the beauty is that where that money is made from efficiency and from productivity improvements, it's really a win-win for everybody. And there are examples in our country and across the world, as I've said in Brazil, for example, also other countries where that system works well. So yes, the private sector, I think, when there's profit, will come in.
JP Luntman, really appreciate the time. Thank you. Political and trend analyst. Good to hear some optimism about something that is a fundamental problem in many parts of our country.
The Money Show.
The Markets.
Marco Evstathiou is the lead specialist for investment and trading sales at Absa CIB. Marco, good evening. Good to have you back in our studio. I mean, quite a big bounce in some markets. Japan very nicely, European markets, even the US markets today, and of course, the JSE tagging along.
Absolutely right, Stephen. A nice sort of 2%, 2.5% moves we saw today. I'm not sure I'd get too excited about it. What we are seeing is just a sort of dearth of news flow around tariffs, and that causing the market to have a little bit of a relief rally. I think the other possibility is investors starting to price in potential intervention from central banks. We saw overnight from 0 rate cuts in the US up to about 5.
I mean, and I suppose the issue is that actually something fundamentally has changed in the US with the way in which Trump has been behaving. And that does mean that actually in the end, you would expect US shares to lose value. People won't trust it in the same way.
Absolutely right. And we've seen a week of great turbulence and huge volatility, particularly in the US, and the Magnificent Seven are the biggest losers, I guess, given how highly rated they were and given that ultimately the US is where this tariff war started.
The JSE today, I mean, it's sort of quality names, Capitec, ShopRite, First Rand. Is that sort of bargain hunting? Are people looking for value somewhere, something they can cling to?
I think both bargain hunting as well as quality hunting, Stephen. I think we've seen investors go to those quality names so that they don't miss out on potential positive news flows we saw today with, I guess, the DA not being forced out or opting to leave the GNU straight away, but definitely wanting the higher quality names within this broader tariff environment.
The Rand obviously losing value. I presume that's because of our domestic political situation and the reset of the coalition.
I think absolutely right, Stephen. Our offshore team telling us that speaking to investors, really the domestic situation in politics is most important. That GNU is going to be the determinant factor of whether people decide to sell their existing assets or come back in and buy our market.
And then Sasol, again, down on the day, and partly because of fuel, but partly because of sort of oil prices. But it's not that simple, is it?
Not at all. I mean, look, I think oil is playing a key part in it, both from the supply side. We saw OPEC Plus decide to increase oil supply. Also, from the demand side, people very fearful about what tariffs will do for demand for oil. But if you look even broader than that, I mean, the supply of gas is slowly drying up for Sasol. This means domestic customers not going to receive that. And the free cash flow profile of the business starts to be worrying a few years out.
I mean, we were reminded last week around the ArcelorMittal recovery and the money that's been put in there by the IDC, how Sasol's shares just are worth a fraction of what they used to be.
Very worrying trends, Stephen. I think, at this point, you could very well see Sasol fall out of the top 40, and I think that was something that no one would ever believe a few years ago. A few other interesting facts. I think just, remember, Sasol is massively important to the fiscus. Nearly 12% of the government's tax stake comes from Sasol, indirectly and directly. 500,000 people employed in that value chain. So a massively important business for South Africa.
Thanks very much indeed, Marco. Eustachio is the lead specialist for investment and trading sales at Absa CIB. Certainly a kind of complex period on the markets, and I'm probably being overly polite when I put it like that. I think we are going to expect a bit more drama through the week, and I'm sort of reminded of what the CEO at Euronext said, that the US is behaving like an emerging market and not a developed country. There are all sorts of conversations around that, but it does show you how the world is changing. More on Beijing's response to all of this in about half an hour from now. You're with The Money Show, just gone 6:30.
The Money Show
With Stephen Grootes, live on 92.7 and 106 FM. Streaming on the Prime Media Plus app.
and DSTV channel 856.
Well, good to hear from you tonight on 011 883 070 and of course, voice notes this evening on 072 702 1702. You might well have a view on the coalition. I mean, just astonishing to look at the language between some of the leaders from the ANC and the DA. And in both cases, I kind of almost want to scream, just grow up, But you shouldn't really be saying to democratically elected leaders, but it's kind of how I feel about it, because I'm sort of, you want to work together, sort of. I mean, I realize complicated, difficult, deep history. And yet, people are sort of, kind of giving in to that feeling. I don't know if there's a lack of rationality or something else, but it seems very strange to me that everybody is choosing these things to have a particular fight on. I don't fully understand the decision by the DA leadership to fight this hard about that. I mean, I get the principle, but really, is it not about something else? And then the ANC response as well. I mean, in a way, you can blame everybody if you like. And at some point, you do actually need to govern, and that's the question that we're not seeing. What really needs to come from all of this, in my view, certainly, is some kind of coalition agreement going forward. That would really be, I think, a game changer in our politics in some way. That's really what we would need to actually make sure that things work and that coalitions work. Not just for this coalition, by the way, for all coalitions. Is that kind of on-the-record, transparent, public, binding coalition agreement.
The Money Show
with Stephen Grootes.
Well, you know that the CEO of the Old Mutual Group, Ian Williamson, he confirmed several months ago that he was retiring. He was going to leave the job, despite being, if I may say, relatively young. He has agreed tonight to talk to you about his time at Old Mutual, what he's learned during his career. And I'd suggest if you're someone who's a little bit ambitious, might be something just worth listening to. Ian Williamson, the outgoing Group CEO at Old Mutual, joins us now on The Money Show. Ian, I really appreciate you taking the time to do this. Thank you very much and good evening. Ian, are you with us? All the numbers are ticking green on my side. They're not ticking green, it would seem, in getting him on air, which means I'll have to do the whole introduction again. But we will get Ian Williamson for you in just a moment. One wonders if cell phone networks go the same way as the coalition at times. You're not really sure if they actually want to do what they are supposed to do, or not. But very strange there to hear that they see that the line literally just dropping. We'll get Ian Williamson back for you in just a moment. Fascinating to watch American politics at the moment, partly because so many, it seems, business people who at one point supported the US President Donald Trump now seem to be turning against him very carefully. And it's sort of 1 or 2, 3s and 4s. But one wonders if it's going to turn into something. The question, of course, is who's sort of brave enough to say what they want to say in public and who isn't. And that can be the difficult fundamental question about this. And this is always the case. If you're going to have some sort of political change, it does usually require people to put their heads above the parapet. And one wonders what's going on in American society among the circles, the people who actually make the decisions that are going to matter in the United States. Certainly the impact around the world of the tariffs, the situation in China, for example, all of that really very interesting and very complex. But you would expect, considering the language that we've heard between the Chinese and the Americans, that this situation is not going to get any better at all. Certainly that it's not going to improve. You'd get a sense really that, in fact, people are just sort of quite keen for a fight. Reminds me a little bit of our coalition. So we'll try and keep you updated, of course, on that situation. But U.S. stock market certainly feeling, and it would appear, going in the right direction today. Quite a strong sort of bounce. The question, of course, is how far does all of this go? And that's something that we don't really know at this stage. Anyway, we'll continue to keep an eye on that for you.
The Money Show, Stephen Grootes, is brought to you by Absa CIB, honored by the 2025 Salter Awards.
We seem to have sorted out the gremlins. Just to remind you, we're doing, having a longer conversation with Ian Williamson, the outgoing CEO at Old Mutual, the outgoing group CEO, I should say, just to sort of get an understanding of the experience and perhaps some lessons that have been learnt that might be valuable for you in your career. Ian, good evening. Sorry about that earlier, and thank you for taking the time to do this.
Thanks, Stephen. It's actually pleasure. I suspect myself and Signal got into trouble with the weather.
These things happen. Ian, I remember when you took over the position of CEO at the Old Mutual Group, and it was a little bit of a, if I can use the word, messy time. Peter Moyer was just leaving. There was a very public dispute. You knew the company very well. You told us before how long you've been with the company. But that still, to take over under those circumstances, must have been not the easiest of times for you, looking back at it now.
Yeah, you're absolutely right. It was quite a challenging period, particularly because there were, even internally amongst our staff, we had some factions, as you can imagine, of loyalties. And when, we've got a staff base in South Africa of around 20,000 people, they broadly mirror the spectrum of society in South Africa. So there are all those kind of dynamics, and just keeping everybody together, keeping everybody focused on the task at hand was challenging. And then in the short period afterward, we went into the hard lockdown and had to deal with all the COVID issues. So the first 3 years, I guess, of my tenure were unusual.
This kind of dispute, unfortunately, it does happen at South African companies. Often there can be an element of race. Sometimes there's a big public dispute. I mean, do you have any advice for people in that position? Are there things companies could do or should learn how to do, perhaps, when that kind of internal dispute goes public?
Yeah, I think it's really about being clear on the principles, the values, and the core, what you stand for, and then being just very factual, open, and honest with people about, certainly internally, your staff, about where you are, what's going on, and sharing as much as possible, and sharing frequently, so that people have a good sense of what's happening, and there's no sense that things have been hidden from them. And really also, I suppose in a corporate environment, very much a call to action around staying focused on the task at hand, on serving customers, on continuing to give the best service we can, and continuing to drive the best solutions that we can in order to keep the business moving forward, and just focus on the real issues rather than what can be quite a distracting narrative that's emerging, which doesn't really affect the reality of what needs to be done on the ground and what needs to be done to help customers solve the problems that they come to you to help them solve.
I mean, nothing succeeds like actually producing a good, valuable service that's better than your competitors, basically, even during times of internal dispute.
Yeah, absolutely.
You mentioned the pandemic, and I mean, I can't imagine after all of that, then the pandemic, once you realized that there was going to be a hard lockdown in South Africa, that it was having a big impact across the world, and now was going to affect us in such a way, and to manage people who you now can't see every day, and they've got to manage people they can't see every day. I mean, a very tough time. I mean, everybody learned so many things. I think we're still kind of learning from that time in some ways, but I'd imagine that would be a time you won't forget in a hurry.
Absolutely not. I think the insurance industry was particularly hard hit because we had a sort of a triple whammy. You had your sales people out in the various far-flung parts of the country who now couldn't go and jump in their car and visit their clients and sit with them. You had, and that affected you in a similar way, your ability to generate revenue and your ability to engage with customers. So that we had enormous in death claims, unfortunately, across our business, and an enormous spike in business interruption claims on the short-term insurance side. So, essentially we had a lack of revenue coming in the door and a lot of paid to on a customer obligations. So just keeping everybody calm through that and making sure that we figured out innovative ways to start to engage with customers. I was actually shocked by how quickly everybody adapted to working online, moving on to Zoom and Microsoft Teams and all the like technologies, and just got up and running fairly quickly. I mean, I think we had literally a 48-hour period where we issued every single staff member across 30,000 people with laptops who didn't already have laptops, or a form of ability to work from home, and got everyone working remotely really, really quickly. It was actually incredible to see. So almost the invention being the on the back of necessity, as it were. So there were some lovely silver linings in the cloud that emerged, and I think some really good long-term lessons around innovation, what we can do with technology, how people are able to respond in a crisis and change really quickly to work in different ways and become effective very fast.
It was extraordinary. I mean, 1 week nobody in South Africa had ever really worn a face mask, and suddenly everybody was. I mean, it literally was that quick. There are many younger, up-and-coming leaders in South African business, and I wonder about the challenges that they're going to face. And I think, for example, in your space, a lot more products are going to be about fintech. They're going to be some, managing artificial intelligence, things like that. Some of the jobs and some of the roles of CEOs might become a little bit more technical. It's impossible, as I'm sure you know, to keep everyone in South Africa happy all of the time. Do you think the up-and-coming sort of generations of people, maybe slightly younger than you, who are going to be running big companies, are they sort of properly equipped for what they're going to be dealing with? I mean, it seems the future, particularly this week, looks a little less certain than it did maybe 10 years ago.
Yeah, absolutely. Funny enough, I was having a conversation with someone earlier today, just reflecting on the extent of the change in the last 3 months. If you'd asked me 3 months ago, I would have said South Africa's economic recovery was on track, interest rates were coming down, wage settlements looked like they were above inflation, consumer ability to own the recovery. And now I think it's a little bit more like all bets off after the GNE challenges and the Trump tariff challenges. So a lot of uncertainty, and I think all you can do is position yourself as best you can for almost any outcome. And you almost have to bring your eyes in a little bit and think quite short term for a while you just sort of navigate through the volatility.
there's a lot of technical challenges in our business when something like this happens because of the level of market volatility, all the issues around rebalancing, hedging positions, and keeping a very, very close eye on your balance sheet come to the fore. But I think the principle is very much in times of uncertainty, bring a time horizon and think hard about how you just get through a week at a time in a way until things calm down a bit. And try to position yourself for any sort of outcome at the end of that to be able to take advantage of any opportunities that might come along. So I think to answer your question about youngsters being prepared, I'm not sure anyone's ever really fully prepared to take on a role, any sort of senior role when you step into it for the first time. And you're always learning on the fly and very much hopefully surprising yourself on the outside as to the things you can do that you maybe didn't think you could do. So I've heard so many stories of people being thrown in the deep end and sort of just learning to swim effectively. And yes, I think you can prepare people through education, through giving them an array of experience, etc. That helps. Ultimately, you still have to be able to actually deal with issues when they arrive on your desk in real time. And most people seem to manage it somehow, so I guess it's a test of some form of resilience depending on the situation you find yourself in.
I mean, it's fascinating to see what people can do. You've been managing a big financial group based in South Africa during a complex time. How much attention should CEOs pay to the political noise? I mean, it can be very loud, our politics. You can't let it consume you, and yet I don't know if you can ignore it either.
Yeah, you're right. I don't think it's either extreme. And it's about having the ability to take the signal out of the noise, which is often more difficult than it first appears. But a lot of it does end up being noise, and then having a support board is helpful as as a CEO and people that you can turn to for advice and who are plugged into the situation as it unfolds. Being some of the structures that exist where business at large is engaging with government, such as the B4SA and BLSA structures, is helpful. So you just keep a sense of what's really going on. But ultimately, short of real catastrophic things, certainly in our business, the fundamental health of the business hangs on the health of the consumer. And so, bearing that in mind, I think is always important. And we've always been very strong advocates for the consumer for that reason, because in the long term, you need to have a well-educated, employable, productive consumer base in order to sustain your business in the long term. Keeping an eye on the kind of almost the through the cycle picture of are the policies and the actions that have been taken good for the long-term health of households, the long-term health of the consumer, the long-term productive capacity of the economy. That's the really important stuff. And, there's going to be a lot of noise along the way and lots of cycles and bumps and shocks and what have you. But you want the trend to go in the right direction, it's not backwards. So, unfortunately, for example, during the Zoom years, we had 10 years of sideways to downwards movement, which didn't help us. But before that, we had a number of years of positive trajectory. And since the GE realized you had that positive trajectory out, there's a lot of noise at the moment, and the reason people are so concerned is because it's risk that trajectory now sort of turn around again, which doesn't help either.
Ian Williamson, it's not a great line, but I really appreciate you taking the time. Thank you for talking to us, and thank you for giving us some of your time and some of your thoughts over your period. I think some lessons there for anyone who might be a bit younger and fairly ambitious. Ian Williamson is the outgoing Group CEO at the Old Mutual Group. You're with The Money Show, 7 o'clock.
And now, The Money Show.
With Stephen Grootes on 702.
Let's walk the talk.
The Money Show with Stephen Grootes is brought to you by ABSA CIB, honoured by the 2025 Salter Awards. Good evening. Welcome to the second hour of the programme. We will have a quick look at the situation between China and the US. I mean, really is going to sort of dictate the terms of global trade, I suspect, if you look at the language between them. Professor Patrick Bond, due to talk to you in just a moment. Also, have a look, of course, at what's happening around our continent, and we'll speak to Dr. Otendo Ndwingi. And I must just tell you that, in fact, the tariffs and everything we've been talking about are having an impact on trade around our continent too. And then from 7:30 in personal finance, Warren is out today, but we'll speak to Andrew Davison, the head of institutional business at Old Mutual. A very specific focus, though, about what happens if you're due to retire at a moment like this when world markets are in such flux. And when you look at what was happening yesterday, last week, how markets were really heading down, so much value being wiped off. What do you do? How do you operate? How do you maneuver during that time? Really important, I think, to listen to that from 7:30. Watching the coalition very closely tonight, watching global trading patterns very closely tonight. Struck by something that Ian Williams said, and I'm sorry about the quality of the phone line. There's really very little we could do about it. But he was talking about how quickly things adapt. And I've always made this point many years ago, when I presented the midday reports on this radio station. You know, of course, Mandy Wiener presents it now. There was a time when you could do an entire show with maybe one mention of politics or economics. By 2017, the entire show was politics and economics, and here we are sort of going through that again, and that's what Mandy deals with now in the midday report between 12 and 1. And the point I'm making is just how the world has changed over the last 10 to 15 years. Of course, there are deep-seated reasons why, but it's just useful to reflect on those. Good to hear from you tonight on 011-883-0702, 021-446-0567, and of course voice notes this evening on 072 or 072-702-1702.
702. Stephen is on The Money Show.
6 to 8 p.m.
Well, strong language today between Beijing and Washington in different ways. Tomorrow, American tariffs of 104% are due to be imposed on Chinese goods by the U.S. China's imposing tariffs of its own. Today, Beijing said it will fight to the end, and the U.S. is guilty of blackmail. The U.S. President Donald Trump himself said on social media tonight that a deal with China would eventually happen. He claimed Beijing didn't know how to start the process going. Professor Patrick Bond is a distinguished professor at the University of Johannesburg in the Department of Sociology, but has immense experience in economics. He joins us now. Patrick, good evening to you, and thank you for your time on The Money Show. So China is implementing tariffs of its own on the US. It's happy to exchange rhetoric, let me put it like that, with Washington. I presume it's been preparing for this day for quite some time.
Yeah, it's great to be with you, Stephen, and your listeners. And the preparation, I would say, began when Trump first took office, if you recall, in 2017. There was a visit to the World Economic Forum in Davos, Switzerland, by Xi Jinping. And he said very clearly, we want free markets. We can't do this protection. He sort of anticipated. It took Trump not just the first term, where he put on a few new tariffs, especially steel and aluminium. And now it's this 104% tariff that goes into effect against China tomorrow. And, you know, there's ships in the ocean and there's all sorts of chaos that will result. Most importantly, I don't know if Trump has been fully briefed that so many components of so much of the United States' own production, because of the complicated, interrelated global value chains, are coming from China, which will devastate his own customers in the corporate sector in the U.S.
Well, I mean, if you just look at the example of the iPhone, I mean, people say to produce an iPhone in the United States would probably make it cost 10 times what it costs now. Some things, despite what Trump may want, may just not be possible.
Yes, and that's a great example because when we think of the turmoil in the eastern DRC, Chinese mines, child labor, environmental degradation, and then the shifting of the coltan, the cobalt, the lithium over to Rwanda and then over to China, and then the exploitation in the Foxconn factories, so well known, where workers were committing suicide. And you see all along that chain, there's surplus extracted, and the most of it is occurring in place Cupertino, California, the Apple headquarters, vast majority through research and development, financing, the marketing and distribution, the sort of new models that come out that are so unnecessary each couple of years. So those are, in a sense, where people like Tim Cook, the head of Apple, will be screaming, and I hope making some calls to say to Donald Trump, stop this before it goes too far. And meanwhile, the Chinese are going to the World Trade Organization to say that the U.S. is not playing fair, which is obviously the case, and whether they can use, let's say, a big neoliberal body on behalf of their exporters. Well, Donald Trump tries to ignore UN institutions and multilateralism at this point. This is really paleo-conservative, Steve. It's a sort of isolationist, nationalist, populist, protectionist, xenophobic ideology emerging, and now China appears to be the sort of free market, big corporate neoliberals that so many of us were worried about gaining ascendancy. It's quite a reversal.
So Trump claims on social media that China wants a deal. China's using language like, words like blackmail, phrases like we will fight this war to the end. It doesn't seem to me that they're in the mood for a deal.
That's right. And then the question is how much destruction of, especially for U.S. consumers, how much inflation they're faced with before rebellions start. First from the corporate sector, we saw Bill Ackman, who was a major hedge fund investor in New York, a big supporter of Trump, begging him to pull back, but also his MAGA base, the working class base, which were promised, they voted for him expecting that on January 20, prices would come down on everything, and it's just been the opposite.
In many countries, politicians have to respond to public opinion. Now, Canada's fighting an entire election on how to stand up to Donald Trump. China's not a democracy, Patrick, obviously, but nationalism is important. And I worry a little bit about the power of Chinese nationalism, which I think politicians, they will have to respond to, and the power of American nationalism or US nationalism, which Trump is obviously kind of the embodiment of. And I mean, China can't be seen, and Chinese leaders can't be seen to come away from this looking weak. They can't lose face. I mean, if you end up with a sort of nationalism versus a nationalism involving tariffs, I just don't see how that ends at all. No one's ever going to blink. No one's going to do a deal.
I know, and especially acute is that there's overproduction. That's a term that the U.S. Throws around when it comes to China, but it is real, and we've seen it with what used to be 9 million tons of steel a year, now down to about 3 because of the massive influx. The Chinese do over 1 billion tons, and so their cost of production, their economies of scale. I mean, across the world, we're seeing this. Let's say Belt and Road or going out or just massive trade. And so that will be a factor, whether nationalism and, let's say, the desire to find new markets, which is very hard in a world economy under this sort of pressure. So when I was in China last, and I spent a week with their top mainstream economist, who had been the World Bank chief economist, Justin Lin, he was getting very worried, including about the ways the underlying core of the Chinese economy, their labor productivity, they were talking about ending their apartheid-style migrant labor, the Hukou system, to try to free things up and improve consumer confidence. So they're also grappling with big problems, and I think you're right that the sort of nationalism or we'll fight to the end rhetoric about Donald Trump also suggests that they're feeling very, very tense about their own economy.
So, I mean, the Chinese economy, and I think we need to talk about this, there's a lack of consumer confidence. We all know about the problems in their housing market. There are concerns in some cases. And I mean, I read this through a kind of Western media prism, so I can't say that I have any special knowledge at all. And what I know comes from biased sources, perhaps. But it does seem that they have deep-seated economic problems, partly due to a lack of confidence. In other words,
yes.
This is not a good time for the Chinese economy to be having this fight with the US.
Yes, as I say, it's an exceptionally productive economy, and they have been opening up consumer demand, but as you saw with the housing market, that's based often on credit. And like we've got over indebtedness by consumers, they do too, and the big dilemma will be whether there are external markets for producing and also for exporting their own factories. And, we've seen some of the delays, for example, in the Messina-Mercado Special Economic Zone, which was meant to be a huge, big Chinese steel and ferrochrome facility dating to, do you remember 2018 when Ramaphosa came back from the Forum on China-Africa cooperation and the slowness, the inability to make those auto companies in the Kuka zone, First Auto Works and Beijing Auto Industrial, those are, I think, reflections of some stagnation that reflects, in turn, overproduction. And now one of the biggest routes, that is the main trading part of the U.S., will probably be blocked. And then the U.S. will start really feeling it, because so many components of so many of their products are also going to either go up in price or just become unavailable. It's a very messy situation.
So, I mean, dialing it back from here, I don't know if politically Trump can. I mean, anything can happen. This is the problem. South Africa, for the moment, sort of not responding to the Americans, I think possibly the best course and maybe the only course. But all of this just shows, I mean, that none of this is going to change, and it's sort of self-inflicted, and the person who's inflicted it is still in the White House and will be there for some time.
And the person in the White House may or may not come to Stanton on November 22nd, 23rd. And that, I think, maybe I disagree with you, Steve. There is something still, an ace up the sleeve, which would be to vote Donald Trump off the island, the G20 island, make it G19. And, the Europeans, with maybe the exception of Italy's Giorgia Meloni, maybe the exception of Argentine President Javier Milei, but I think everybody else in that G20 bloc is so fed up, and I wouldn't be surprised if the Chinese start to push a motion help with the U.S. They're just doing so much harm on climate, on world health now, on world economics, on cutting the aid programs, the humanitarian, the food aid. They really don't belong in a civilized company in the G20, do they?
Professor Patrick Bond, thanks very much indeed. Do appreciate your thoughts. Professor at the University of a distinguished professor at the University of Johannesburg's Department of Sociology, but as you know, a long track record in economic issues as well. Your views, 011 883 0702 021 446 0567.
The Money Show.
The Africa Business Report.
Dr. Rotendo Ndwingi, founding director at Tribe Africa Advisory and author of the book Rumble in the Jungle Reloaded. Rotendo, good to see you again. Thanks for coming in.
Always a pleasure, Stephen.
We've been talking about tariffs, well, pretty much forever, it seems. And I mean, one of the great and terrible examples is Lesotho's, 51%, some of the highest tariffs in the world. And of course, what do they make? Golf shirts.
Yeah. And it's actually interesting, Stephen, and I think the analysis I did is that, with the tariffs, and if you're looking at African countries, and I mean, there are two countries I'll be specifically talking about today. One is a small country, which is Lesotho, and the other one is Nigeria. And obviously, Lesotho, as we're well aware, has got like 50% tariff increase, and that is because America blames them for about a 99% increase in terms of the exports coming from America to them. But what is actually interesting is that, you begin to actually want to take this in a bigger context and appreciate from an Africa perspective. I was kind of asking myself, what is the contribution of African trade to American trade? Now, globally, the American trade is probably at about $5 trillion. And that's probably almost a 50-50 split between imports and exports. Africa's trade with the U.S. collectively, all 54 countries, Stephen, is $72 billion, which is, on average, that's 1% of the trade contribution to America. So the reality is that all these tariff increases from an Africa perspective on U.S. is not going to change things significantly in terms of the U.S. global trade relations. I mean, if you look, for example, China itself probably sits at about $500 billion with the U.S., which is like 10%, so that's a bit more significant. But what I'm highlighting is that at the end of the day, I think there's a bigger motive, which we've always talked about in terms of trying to attract other deals in terms of this whole triad muscle. But coming to Lesotho, in terms of being part of Africa, the implications that have been applied to them with regards to these tariff increases will probably impact about 12,000 jobs in terms of the manufacturing that they do, that they export to the U.S. 75% of their products are exported to the U.S. They export to the U.S. probably about $237 million, but in return, they only import from the U.S. about $2.8 million. So you can actually see the big surplus to Lesotho. Will these tariffs have any big trade positive impact to the U.S.? I don't think so. But ultimately, as the suspicion is that probably America wants to leverage this for the diamonds and the other endowments, which is always the talking point. So a small country, I think it's taking a huge knock with a population of 2.3 million. But ideally, the war from a Lesotho perspective is quite unique from that perspective.
No, I mean, it has such a big impact on Lesotho and no impact on America. I mean, that's really...
That's really the boils down to it, yeah.
It's terrible. And Nigeria, I mean, the Forex market in Nigeria affected by US tariffs as well.
Yeah, and this highlights again the point, Stephen, that at the end of the day, the way these tariffs are affecting each of the African countries is unique. So from a Nigeria perspective, the 10% baseline that was given, and then on top of that, the 14% specific to Nigeria, has caused a devaluation of the currency. And this has forced the CBN, which is the Central Bank of Nigeria, to inject $197 million of liquidity to boost the market in Nigeria. And we know that the reason that reserve banks actually do this is that they want to buy assets, or they want to lower interest rates, or quantitative easing. All of these contributes in terms of increasing and encouraging lending, as well as increasing the money supply. But ultimately, I think the point here, Stephen, is just to highlight again, Nigeria, one of the biggest economies in Africa, is also taking a unique knock with regards to what is happening. It does a lot of exports to the UK, to the US. Obviously, petroleum is one of the big things, but it does a lot more imports from there as well. But again, it's just highlighting again that although everybody's responding in the same way to the US and being cautious and not being aggressive, each country is being uniquely impacted in terms of from an economical perspective with regards to these tariffs. And that, for me, is a bigger talk with regards to ACFTA, Pan-African industrialization. Is this going to be a divide and conquer scenario, or is it going to force people to be united and collectively say to America, look, how can we structurally solve this problem? And it will be interesting to see how that all comes out in the wash.
So much to look at there. Libya devaluing its currency. This is for the first time in a while. And Libya technically still is sort of two governments, but I think one central bank. Is that right?
Two governments, one central bank. Maybe we should tell them about the GNU and how that can work. But the reality of this is Libya, after 4 years, it's first time in 4 years for it to devalue. And what's driving the devaluation? It's been a crisis over the control of the central bank that has slashed oil output as well as exports. You're rightly on point, Stephen. Because of the war that happened, there are two parliaments. There's the East and the West Parliament. And they've been battling in terms of running the country together. You know, those parliaments are sort of supported by militia and some foreign elements. So it's a bit of a cocktail of a disaster, but there are certain reforms that they're putting in place to get things right. But unfortunately, at this point in time, spending is high. At the last stats that I read, Stephen, the government has spent about 46 billion over budget, and public debt by the end of this year would have moved from $54 billion to $66 billion. So there's still a lot of work, and unfortunately for Libya, one of its key exports is oil. And with all the dynamics that's happening globally, that's obviously they need to diversify more than that. But that's a challenge that's still happening. It will take time to resolve.
NVIDIA, and I mean, they obviously have had a difficult week, but they and Cassava are looking at the company's called Cassava, right? This is an African AI initiative.
Yeah. So Cassava, owned by one of Africa's billionaires, and that's Strive Basiwa, and I must state he's from my country, Zimbabwe. So we do have billionaires in Zimbabwe, but not in Zimbabwe. If you can.
I'm really not going to say anything, Rutendo.
Maybe I should go on the Trevor Noah show and become a comedian. But I think the point here, what is quite key, is that they've started what is called, Strive Basiwa through Cassava have been investing significantly in AI on the African continent, and they've started this what they call an AI factory. NVIDIA, multinational technology company based in the US, they are jointly going to invest about $720 million with regards to developing the AI platform and technology as well as skills on the continent. 52%. I think it's key to highlight that Africa's internet penetration on the continent is 52%. In other words, the growth of internet usage on the continent over the last 5 or 10 years is going to be 52%. The global average is 17%. So it just highlights the opportunity and growth on the African continent. What is key about this investment, Stephen, is that there are certain centers they have identified in Africa where they're investing, South Africa, Egypt, Nigeria, Kenya, and Morocco. They are going to deploy the main engine that drives AI development and content from a hardware perspective are GPUs. So these are the graphic processing units, which are your CPUs on steroids, to cut a long story short. Stephen, they're going to deploy about 12,000 of these across the continent. The average price for one of them is $55,000 US. You do the maths in US dollars, it comes to $660 million US, which is about 12 billion rands. So it's quite a significant investment. And the idea is that they're going to make this investment with the focus with regards to contributing to startups and also equipping developers, especially in the healthcare and fintech space, as well as government. So it's an exciting investment by an African billionaire to make a fundamental change in terms of the landscape with regards to AI. So, and obviously it's bringing in multinationals from the US, ironically, onto the African space. So it'll be good to see how that develops, Stephen.
And then very quickly, Garnier is launching a super UV SPF 50 sunscreen in Kenya.
So Garnier, obviously one of the main product lines for L'Oreal, which is a French company, and it's skincare, so maybe something that I use and maybe look a bit prettier. But I think the key thing about this investment is that Kenya is one of the sites where L'Oreal manufactures in the African continent. This is one of their flagship products that they've launched, and I think the key thing about that is when you look at the skincare health or makeup market on the African space, it's probably about $66 billion compared to the market size globally is $500 billion. But still, I think the point here is that these kind of investments that translate into simple things like face care, healthcare, at the end of the day, contribute to industrialization, contribute to jobs being created, and position us from a growth perspective in the economy. So it'll be actually great to see how this takes off and obviously change the lives of people in all aspects.
Dr. Rotendo Hundwingi, thanks very much indeed. Good to see you, founding director at Tribe Africa Advisory.
The Money Show.
Personal finance.
Good evening. Warren Ingram is away today. He will be back with us next week. But imagine you're this person, right? Imagine you've had a retirement fund. You've been doing everything that Warren says, which means you've been using the D word quite a lot. You've been diversifying all the time. And you get to the point where you decide in April 2025 that you're going to retire. And you look at your fund, you look at your stocks, however it's managed, you look at the value that you have locked up in markets, and you look at what markets have been doing over the last week. I mean, what do? Do you panic? Do you have a cry? Do you work another 10 years? Well, this is the conversation that we're going to be having tonight. Andrew Davison is the head of institutional business at Old Mutual, and he's agreed to come and talk to you this evening. Andrew, nice to meet you. Thanks so much for coming in.
Good evening, Stephen, and to the listeners.
Okay, so, I mean, I've been reminded in the last few days about a sort of, I don't know if it was apocryphal, but it was told to me as if it were true during the pandemic when markets dropped 30% and people about to retire just took their money out, put it under the bed because it was the safest thing to do. And I've been thinking a lot about that. I mean, today's situation is very different, but I think some people will be tempted if you think Trump's going to be in the White House for another 3 years, actually just take it out.
Yeah, look, I mean, there is, in investments, there's always the behavioral risk that we all face because we are human and emotion is part of our being. And successful investing does require you to manage your emotion and your behavior in relation to your investments. And one of the things that is very important about retirement and saving for retirement is you actually do have to take risk. And the reason why you have to take risk is that none of us can contribute enough of our salary. If you were contributing 40% of salary from age 25, you could take a lot less risk. But we don't have that luxury, any of us, so we want to contribute 10, 15% is probably the appropriate level. But if you're going to contribute 15%, you need inflation plus 6 on average per annum, and that means risk. And so the problem with risk, obviously, is every now and then a crash like 20, 30% does come along. We can refer back to a few of them. The late 90s, there was a crash. There was the global financial crisis in 2008, 2009. There was, as you mentioned, COVID 2020 as recently as that, and now we're back in turmoil now. So you do have to take risk, but you also have to be comfortable with risk, and that's tough.
So someone who's, a year or two away from retirement and looking at this sort of picture, I mean, where do you start with trying to assess it? Do you believe what everyone says, which is shown to be true, that markets recover? The problem for you is the time scale in that sequence, in that situation.
Yeah, and what we do try to tell members of retirement funds is that you do need to focus on what your real time horizon is. And there is a tendency to say, I'm a year away from retirement, my time horizon is 1 year. That's not actually true, because retirement is not the end goal. It's not the end point. It may be a point where you are doing something with your capital, but unless you're taking all of it and blowing it, which is not a very good retirement strategy in the first place, but if you have a genuine retirement plan, it means converting that capital into an income. And that means staying invested in some way. And so your time horizon when you're 1 year from retirement is probably more like 25 or 30 years. It's an unknown time because it is until your death, but it is a lot longer than 1 year. And so I think looking past the fact that you thought you were going to have 1.5 million on your 65th birthday and you actually only have 1.4, it is a little painful, but you do have to look beyond that and say that actually, maybe there's a recovery that happens. And again, I do think there are strategies to manage some of that risk as you're approaching retirement. But again, when you're close to retirement, just before retirement, it is the peak of most people's capital. Prior to that, you're building it up, and after that, you're drawing it down. So you can't afford, to my point about risk, to be too conservative and be parked in cash for 5 years at the peak of your capital because you're worried about a number at your 65th birthday, which is actually not even an appropriate end goal.
That's such an interesting point, that it's the peak of your capital. I mean, that's when you have the most leverage. You actually have to do the most with it.
Yes.
Then. I mean,
got to get it working for you.
You don't want to take the most risk necessarily, but you've actually, you can really get better multiples if you do invest it wisely for just 5 years.
Yes, exactly. And I mean, one of the other things that we talk to members of retirement funds about is the dangers of cash as an investment strategy for retirement. So people think of cash as the least risky investment strategy, and it's the least volatile. But the problem is, referring back to what I said, where you need inflation plus 6, pretty much. You could maybe do 5.5 or whatever, but you need in that range to be able to have a successful retirement plan. Cash is not going to give you that. So in terms of capital adequacy at retirement, cash as a risky strategy is not going to get you the returns you need. And so, and again, to the point, is at that very peak of your capital, you can't afford to have inflation plus 1 instead of inflation plus 6 for 5 critical years.
One of the things that would be tempting to me as a non-professional in all of this is to say, okay, can I take my money out for a year and then put it back in? I mean, some kind of like pause mechanism. I imagine that's actually in most products quite a complex thing to do, and you might lose something in the meantime.
Yeah, look, there are. It's first of all, it's always tempting to want to take out the money and avoid the risk, and that's one of the things that's quite tricky, is that we use this word risk, and as humans, we're actually taught to run away from risk. And I've just said earlier in the conversation, you actually, from an investment point of view, you do need to embrace it. That's not to say that you must take reckless risk. You used the word diversification. Absolutely. And the reason for that is you do want to take risks, but you want to take a whole bunch of them, and some of them are not going to work out and others are. And as an average, you're going to get hopefully a reasonable return. So it's absolutely an essential part of taking risk. That's why diversification is there. So you do want to be able to, get those extra returns by having the extra risk, but you don't want your behavior to come to undo that value at the wrong time. And the wrong time is when there's a crash and you're panicking and you're saying, I just want to run away from the danger. I want to take my money out, put it in the couch, put it under my bed. The problem, as you know, is that you don't know. It's very difficult to do that, and it's very difficult to do it twice, because you have to do it twice. You have to take it out at the right time, just before there's a crash, and you have to put it back in at the right time, again, not too late when everything's recovered. And, of course, those two things are very hard decisions to make. Normally, it's only after the crash has happened we want to take it out. That's the wrong time. And also, we wait too long to get back in, even if we made the first decision correctly. So we've missed out on a lot of the rally that happens when everyone realizes everything's good again. We can go back into the market. Those things are not easy to do. And so the advice is, because those two decisions are very difficult, rather just stay invested and and roll with the punches, so to speak.
I mean, it's interesting because it seems to me that this it's not a crash necessarily, but the events of the last few days are slightly different to many of the other crashes, because the other crashes did kind of arrive on the arbitrary Black Monday. In this case, there was a warning that it was coming because Trump had said he was going to do it. Now, we might have discounted that, but there was in a way, fair warning. The other thing that I keep coming back to, and I keep making this point, and I bore myself when I make it, but I keep making it, which is that in the past, when there was a problem, the people in charge worked to fix it. In this case, the problem is created by someone who's not going to work to fix it. And that would mean, as an investor now, you would think, okay, I'm not convinced this is going to be resolved. I'm going to retire in 3 years. He's still there for 3 years. What do I do now?
Yeah, look, I mean, it is tough. I do think that the events of the last week, and as you say, it's not only the last week, but it's kind of become crunch time in the last week. They are difficult because they are a potential reorganization of the way the world works. And that is a tough thing because none of us really knows how this is all going to work out. So, as you say, it's not really a crash yet. There's been a lot of panic in the last few days on markets. But then the last couple of days here in SA anyway, we've had a little bit of a recovery of some of those losses. And the same on other global markets. But, we're not out of the woods yet either. We still don't know. And I think we are probably in for a lot more volatility. So to your point, it is a very tough environment to be trying to make decisions like, do I retire now? Do I work for another year? And sometimes people don't have that luxury either of saying, I want to work for another year. If you're at 65 and the retirement age of the company you're working at is 65, they may not keep you on till 66 or 67 because you want to work longer. So, I do think that, again, I think most of us need to give ourselves options to be able to be a little bit more flexible around certain things. So, again, planning to have some sort of ability to, even if it's not work in the same job you were at, but to be able to earn some sort of income, a part-time job, maybe lecturing or consulting or, I do know that a lot of people are successful in working beyond retirement, not necessarily full-time and not necessarily at the same company. But, and the other thing as well is I think it is important to diversify your financial situation, not just from an investment point of view, but beyond the retirement fund. In other words, have other assets, have other savings that are outside of that, those savings that are locked into a fund where you actually have to get a pension out of them. And that gives you more resilience to hopefully be able to withstand these sorts of situations. And we saw it in COVID. People with savings, people with some sort of, financial backup, so to speak, actually were able to ride out the COVID pandemic and those disruptions to our lifestyles a lot better than people that were actually went into that over-indebted, for example.
I mean, people with capital came out of COVID very strongly. Look at the companies that did well.
Yes, that's right.
And I suppose the other, to your point about how necessary risk is, it was fascinating looking at some of the companies that did well on the JSE today. Things like ShopRite and Capitec. People are snapping up those shares because they're good companies. They're on a roll. The value is there, but the shares are now at a very attractive price.
So look, I mean, obviously in an environment with heightened risk, there is generally the good advice is to look for quality because those are the businesses that are going to be able to ride out, crises, turmoil better than a business that was on the edge going into the crisis when things were fairly good. If you were only just being able to be profitable and doing well and actually conditions were benign, in a tough environment, it's going to be a lot harder. So there is generally a bit of a flight to quality, and I think you saw some of that, as you mentioned already. And that applies, to good South African companies. It applies to good global companies. And again, that's why I think you do want to put your trust in a good asset manager that looks at the landscape and says, where are the best businesses? And that's hopefully the type of investment portfolio that's going to ride through this turmoil a lot better than something where you're taking a lot of risks. You're in businesses that are on the edge, that are maybe not as, businesses that have been around for a bit of time and actually have seen a few crises. Those are often the good ones when things turn tough.
Flight to quality. One day you're going to hear your children listening to a band with that name, and you can tell them you heard it here first on The Money Show. Andrew Davison's head of institutional business at Old Mutual. He's with us for another few minutes. What to do if you're planning to retire at this moment of market uncertainty.
The Money Show.
Personal finance.
Andrew Davison's head of institutional business at Old Mutual. We're talking about retiring at a time of market volatility like we're seeing now. Andrew, obviously retirement is all about planning, right? And part of it is about different life stages. You do different things. And when you get to, say, let's call it 55, one presumes you start to make investment decisions. You're approaching, as you pointed out, the height of your capital, but you also need to start planning for moments like this. How would that change your investing behavior? Would it mean less risk, for example?
Yeah, so what we see actually in dealing with trustees, business owners, and members of retirement funds is that prior to around about 50, people don't even think about retirement. It doesn't even really enter their realm of planning. Obviously, there are exceptions, but a lot of young people just don't think about retirement. And then around about 50, people suddenly realize that this thing could happen to them, this retirement thing. And that's when we see a lot more interest suddenly in the retirement fund, in the investment strategy of the fund. We've even had situations where, an owner of a small business has no interest in the fund and literally is quite obstructive in the retirement fund until they get close to retirement. And then suddenly the retirement fund is the most important thing and it's getting a lot more attention. Anyway, that's on a sort of an emotional and behavioral level, is that I do think that then people start making those arrangements. They do start planning their private lives, their plans, are they going to move house? What are their kids doing? Are they going to still be dependent on them in some way? Because, as you know, there's that aspect of retirement planning for a lot of people. But actually, there is the investment side of things as well. As I say, you can't be too conservative, but there is room to de-risk to an element close to retirement, because you do have a lot of exposure to that capital being a lot more volatile, and it is a time when you're making decisions on what to do with it. And so there are things like life stage strategies, which actually aim to de-risk your investment strategy as you approach retirement. Take out some exposure to the stock market, maybe replace it with slightly more conservative assets like bonds and cash. But again, not 100% cash, but just taking a little bit of risk off the table. And those are valuable. But again, to my point, you don't want to start doing that too early. So it's only in the last few years before retirement. So you should push that growth strategy as long as possible, and then start, considering and again, a life stage strategy is ideal because it's automatic. You don't now have to be thinking about it. You don't have to be making active decisions trying to decide, should I switch this month or not? Because now it becomes a behavioral thing again. You start saying, maybe I shouldn't switch this month. It's too many decisions for people. So an automated life stage strategy is often a good plan for people. And again, it's gradual. So if your switch happened to be happening in the last few days, it was only a small portion of your capital because it's a gradual process. So it's not something where, your switch happened on the day after the market had fallen, 2 days of 4% falls.
I just want to give you the nightmare scenario, right? Mm-hmm. There will be people who have lived in Venezuela who've just seen their investments disappear. In Zimbabwe, in fact, at certain times in that country's history. I really don't foresee that happening here in any way. But how do you guard against something like that? That's what keeps people up at night. There's an astonishing comment by the CEO at Euronext today that, the US is behaving like an emerging market, not a developed country. A problematic comment in some ways. But suddenly we have, things seem a lot more fragile, perhaps, than they used to be. It shows you America's place in the world, doesn't it, when I say that? But I mean, people do worry about that kind of collapse scenario, and that's partly because we've all watched too many movies.
Yeah, I mean, I mentioned earlier that you should take risk in your retirement strategy, your investment strategy. But risk, there are some very serious consequences if it seriously goes pear-shaped. There are examples that you've mentioned. I mean, Japan is another one, where the market peaked in 1987. As you know, there was then a major crash, and it only just recovered a few years ago to that same level. And I was at a conference a few years ago, and there were some Japanese delegates there, and they said, one of them stood up in an open session and said that in Japan they only have absolute return investment strategies. In other words, those that are designed to protect downside. Because after that sort of pain for decades, your whole psyche around investments is affected, and that applies to us as individuals, depending on when we grew up and experienced markets. If we happened when you first started investing in markets, if you had a whole lot of bad years and bad experiences, you might actually say, I don't want to go near that stock market anymore because it just didn't work for me. Whereas if you happen to have started investing at the start of a boom, in 2003 or 2004, and you had, 20-30% a year for 5 years, you'd say this investing game is such an easy thing. So it's tricky, but you do need some risk, and again, diversification. So in other words, don't have all of your stock market exposure in Japan or Venezuela or Zimbabwe or South Africa. It's back to that diversification thing, because if you've got it in a few different places, if you've got some exposure to the US, but again, not too much, because even though the US is a nice, safe, developed, giant economy, it's been very expensive on the stock market there for a number of years. People have been saying this thing's expensive. And when things are expensive, the downside risk does increase. And that's what we've seen.
Andrew Davison, thanks so much for coming in. Really appreciate the time. Head of Institutional Business at Old Mutual.